Hi people, Alibaba just released their latest earnings, which missed market estimates, but their stock on both the Hong Kong Stock Exchange as well as the U.S. Stock Exchange managed to still rally. So today we're going to look into why the market is still feeling pretty optimistic about the stock itself. But before we do that, let's understand how the business is structured. So they have three major pillars. The first one is their e-commerce in China. Second one is their international digital commerce group. And the final one is the cloud intelligence group, which is basically the market is most excited about. At a quick glance of their performance, Alibaba China e-commerce group, it's still the largest part of the entire revenue pie, but then the cloud intelligence group is what excites the market the most because they're seeing a 26% increase for revenue year on year. So now we have a high level understanding, then what I'm gonna do is I will deep dive into each of the pillars and talk about some of the highlights. With e-commerce in China, revenue is up, but EBITDA is down. Great news is that we're seeing e-commerce as a sector in China is recovering, especially with the Chinese government pushing a subsidy program that encouraged the Chinese citizens to trade in their old digital products for new ones, which boosts consumptions. Another great news is that if we just look at Alibaba instead of the wider market, they are really nailing the AI application when it comes to e-commerce. So there are quite a lot of benefits for different stakeholders in the entire scene. For consumer, obviously they get more personalized recommendations when they're shopping on the platform. They have AI-powered assistants, which can help them to find the best deals during different seasons. Customer service is also enhanced because of their large language modeling, which handles better customer inquiries with more targeted answers, as well as providing services around the clock. This article published in 2023, it's a great example to show how the company is investing and utilizing AI assistants to help different consumers throughout the shopping journey. So this application, which says Taobao 11, that translates to Taobao Q&A, use an algo to analyze user input and their shopping habits to provide more targeted shopping recommendations. For merchants, they use the AI toolkits provided by Alibaba to generate relevant content at a lower cost. They can also analyze consumer demand and competitive data to better inform their product planning and boost their sales. On the logistics and operations end, AI help with analyzing buyer trends and forecast demand patterns so different sellers can manage their inventory levels and streamline the entire operations. For logistics, Cainiao, which is a company under Alibaba that does delivery, they use AI to optimize shipping routes and automate some of their warehouse operations to speed up delivery so consumers get their product faster. So everything that I've been explaining right now really explains why the China's e-commerce pillars revenue is going up. But again, our other question was why the EBITDA is down 21%. And one of the reasons being they're actually burning cash in some other categories that they're playing in. An example here that we're showing is the food delivery market. JD, Meituan, as well as Alibaba, they're burning cash to acquire as many users as possible at this stage. All companies are experiencing losses in this competition, but then the game is still dominated by Alibaba just because they have the most financial resources and they're really committed to gaining more market share, which they rank number 2, owning 43% of the food delivery market in China right now. Another highlight in this business segment is that they have just entered the quick commerce market by the end of April 2025. Quick commerce essentially means that the delivery will arrive within an hour after a consumer places an order. They have seen initial success in this initiative with a 25% year-on-year increase for monthly active consumers on Taobao. And the reason for them to enter this business is because they want to acquire as many users as possible so that they can cross-sell products from different platforms on the Alibaba to generate synergies. But this ambition comes with a huge cost, as we're seeing the company is spending way more expenditures in sales and marketing to capture the market share. On the bright side, they're still relatively well positioned just because they have the most cash among the competitors and they have the most long-term investments in this area. So the narrative here is really they're experiencing short-term pain, but they're aiming for the longer-term gain that they're seeing as long as they have that user acquisition as well as they're building up the technological infrastructure. And they're envisioning that just with this quick commerce segment, it is going to generate 1 trillion RMB annually in terms of GMV. In terms of why the market growth, according to a report released by the China's Ministry of Commerce, the quick commerce sector, it's still growing at an average annual growth rate of 28%. So that is the justification for, even though it is expensive, but the company still wants to put initial investment to grow this area. So now let's move on to talk about their second pillar, which is their e-commerce business elsewhere internationally. Year-on-year revenue is looking really good, up 19%. But if we look closely, this business segment is not profitable yet. It has a huge improvement in terms of driving towards break-even, but it is not generating any profits as of now. And the reason for the improvement, it's because of their logistic optimization and investment efficiency, which lower their unit economic cost. With their wholesale platform, which is also under this business segment, they are seeing a broader adoption by merchants to use their AI-powered tools, which also help Alibaba to better monetize on these enhancements. And now let's look at their cloud business, which the market deems as the most promising segment of the three. It is growing at a 26% year-on-year if we look at revenue, and the momentum is primarily driven by the public cloud revenue growth. The management team also highlighted that AI-related revenue accounted for over 20% of revenue from external customers, and that the AI-related product revenue maintained a triple-digit year-on-year growth for the 8th consecutive quarter. And the increasing demand is driven by the need for computing, storing different data, and other types of public cloud services that support AI adopters. According to a report published by the International Data Corporation, Alibaba Cloud holds a 23% share of the AI infrastructure market, ranking number 1 currently. And even if we compare Alibaba's growth to some of the U.S. counterparts, they rank in joint second place in terms of cloud growth alongside with Google Cloud, just after Google Cloud's performance. Looking at their guidance, they will continue to invest 380 billion in RMB in AI and cloud infrastructure in the next 3 years, just to make sure that they are still in the market leader position. Any great businesses also come with risk. At the moment, there are 3 major risks that we're seeing. First is that their free cash flow was at negative, primarily because of all the investments and all the expenditures that we just touched on. And because of that, then their adjusted EBITDA decreased by 14% year-on-year. Given how they are prioritizing growth over profitability in both the cloud and quick commerce investment. Amidst the risk, the news where the company is manufacturing and making their own AI chip in China really excites the market and contributes to the stock jump as well, because the company claims that the chips that they're making is designed to handle a wide range of AI inference tasks, and with that in hand, it will allow them to reduce their reliance on chips supplied by NVIDIA. If we calculate the PE ratio using 135 as the hypothetical stock price, the PE ratio for the company is still relatively cheap, between a range from 13.28 to 15.96, which is much lower than the US counterpart Amazon, where it is at around 34 PE ratio. If we look at the technical analysis, this is not the best time to get into the stock right now, just because right after they released their earnings, the stock price was already up more than 12%. I think that if the stock is going to over this area in the upcoming few days, with a support level at around 130, then this would be an area that we would love to get into this stock, given if this support level is still effective. If the stock price drop below this resistance level at around 133, we will think that maybe around this level, 122, then it would be another support level that we can also get in. Now, if the stock price is going up without hovering over this area, then we're seeing that resistance level will be around 145, and you can take profit at this level. If you like this video, like and subscribe. Join our investment community on WhatsApp, which is free for now, through either this QR code, or we also link it in the description box down below. Feel free to comment if there is any topic that you want to hear about, any particular technical analysis that you want us to walk through. See you in our next video.